Well, hello and welcome to TradeStation. I'm Don Pratl, Dr. Don Pratl, the Director of Trader Development and Education here. And today we're going to talk about the advantages of including options in your portfolio. Our webinar today is designed to provide you with a fundamental understanding of stock and index options trading concepts. It's intended as only as the first steps in helping you determine the additional areas of options trading theory and concepts that you'll need to research and master before beginning to trade options. First of all, I want to make sure everyone can hear me, and obviously you're seeing my camera. I don't often utilize that, but I want to point that out that we are breaking new ground here in our educational component. Good to go. Thanks, Nick. So in order to trade options, we need to develop an understanding of the nature of options, the risks and benefits of options, how they're priced, the various option positions and strategies that you might use to employ options in your portfolio. We're going to cover some of the essential trading concepts and the terminology that you're going to need to get started trading options. We're going to attempt to share in my monitor, and we don't often do this in the morning briefings or the other webinars, share and record on the same screen, but we're going to try that later on to give you a picture of the TradeStation option chain. So let's get into some of the housekeeping. As always, there's housekeeping. I'm, as I mentioned, the Director of Trader Development and Education for TradeStation, and I've joined TradeStation back in 2016 after holding similar roles to this one for some of the other online brokerages. I've had a very long career, as you can tell, in financial services industry, and many of my stops along the way involved trading and investment strategy programs for retail investors. Since back in the 1980s, I've held various positions, including many years as a floor broker at the Chicago Board Options Exchange, trading floor, doing trading floor order execution, and I've also held positions in personnel management, marketing, sales of this product, and customer service areas. I've got some licenses with FINRA. They don't make me an expert. They do allow me to talk to you about these concepts, the 3, 4, 7, and 63. I work quite extensively throughout my limited free time, the rest of the academic year, with some Chicago area colleges as an adjunct instructor. I've been doing that since 2004 at a range of institutions. I teach undergrad and graduate students, some doctoral programs using in-class and online formats. Over the years, my children have begun to call me the Batman of our industry because I do so much work at night with my online students, and they know that during the day that I'm busy with our online customers. So thank you for indulging me that little bit of my background. Our presentation is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss are going to be considered demonstration purposes only. They are not recommendations. Our presentation is not an offer or a solicitation of any kind anywhere where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading may not be suitable for you, and options trading does carry a high degree of risk and may not be suitable for all traders. I've included in the chat panel the brochure that you see on the screen, the characteristics and risks of standardized options provided to us by the Options Clearing Corporation, who is our one of our industry regulators. Also, there's another document regarding some of the other asset classes that we are trading here at TradeStation, but we won't cover much of that today. every Monday, David Russell and I participate in this in a discussion of and offer our market insights regarding the trade forecast for the week, things that are on the calendar for the week. We run through a calendar of earnings and anticipated moves in the marketplace and various announcements that will be coming along. David shows his breadth of experience in tracking various stocks, bringing forward names that maybe you haven't heard of, and talking about the impact that they might have on your portfolio. So join us on Mondays, 1/2 hour after the market closes, for the Market Insights webinar. If you're in Chicago, we are hosting Learn from the Pros to Trade Options Like a Boss on Friday here at our headquarters here at TradeStation, downtown Chicago. The Option Stars 2018 conference will help you jumpstart your options trading. By clicking through into that link, the TradeStation.com Option Stars, that will provide you with details on how to attend and how to get here. So a lot of traders have begun using, since 1973, options as an integral part of their overall trading strategy. Option trading offers benefits that can create additional profits when, and this is kind of distorting my view of things. All right. Can you still hear me? I needed to turn that off. Watching myself was a bit confusing. Option trading carries benefits that can create additional profit and risk management that trading stock alone just can't provide for you. And options offer trading flexibility, increased leverage, and limited and measured risk going into a trade. In addition to trading options for profit, many traders use options to increase returns and generate income from stock positions and as a safety hedge for their stocks and portfolios. So let's take a look at these benefits of trading options. They are in no particular order: flexibility, limited risk with unlimited profit potential, and leverage. So options provide this extremely flexible investment tool. Most active stocks, ETFs, and indices have options that are available to trade. At any given time, you can buy or sell option contracts that have a wide selection of strike prices and expiration dates. In addition, most of these underlying assets also offer LEAPs, long-term anticipated, long-dated options. LEAPs is a LEAPS, an acronym for these long-dated options, which offer, they have expiration dates that can be 1 or 2 years away. And when trading options, you can only benefit, when we're trading stock, you really can only benefit from the specific directional movement. You're either long or you're short. But when you're trading with options, you can benefit from many other market situations. Options can be bought and sold in many different combinations because of their unique risk and reward structure. This allows you to take advantage of almost any market condition. Option strategies can be created to make money in rising or declining markets, quiet markets with no price movement, or explosive markets where the direction is not so certain. Options can also be used to generate income or to hedge a market position, hedge a stock position. So there are a number of option trading opportunities that are strategies that offer multi-leg strategies that you can learn about and employ in your option trading. We won't be talking about spread or combination trading today. We're simply going to go over these details on how single options will benefit your portfolio. Now, when you buy a call or a put options contract on a stock, you have the right to buy or sell, respectively, 100 shares of the stock at the strike price of the option on or before that expiration date. If you buy a call option, you benefit from the unlimited profit potential as the stock moves higher. Buying a put option, you benefit from an unlimited profit potential as the stock moves lower. As the buyer of an option, the maximum loss that you can incur is limited to the amount of money that you paid for that option contract. Conversely, the seller of an option contract has limited profit potential and unlimited risk potential. Note regarding put options, it's common to say that the buyer of an option has unlimited profit potential. However, you should note that the buyer of a put option has profit potential limited by a price of 0 for the underlying asset. That means the underlying asset can't go down indefinitely, only to 0. So it's common to say that the seller of an option has unlimited risk. That's the other side of this. The price of the option, if you've sold it, could increase as your opening position, could increase infinitely before you have an opportunity to close it. So the seller of a put option has risk limited by a price of 0 for the underlying asset. That means that the underlying asset can't go down indefinitely, only to 0. Now, options can also be used to protect an individual stock position or a portfolio of stocks from adverse market movement. By hedging your stock or portfolio positions with options, you can limit your losses and lock in profits at a certain price if the market moves against you. So on this graph, and let me finally point that out, I've wanted to use these for so long. Here is our entry price, right? This is our limited risk as a buyer, 0. We can't lose more than we've paid for either the put or the call. Well, we can lose everything that we paid for the put or the call. If we buy a call at this, where it intersects here, and it increases in value, it will go right along with the underlying asset. If we bought a put, the arrow would go in the other direction, lower with the stock, and it would increase in value. So they would go conversely to each other. You would see the price of the stock moving lower and the price of the call going higher, or put going higher. When you buy or short an underlying stock or an index, you have unlimited profit and unlimited loss potential. But when you purchase a call or a put option, you have limited risk, but you still have unlimited profit potential, as identified here on this screen. All right, let's get that out of the way. Now, option trading also has the advantage of leveraging capital by allowing a small amount of capital to control a larger dollar amount of the underlying asset, the stock, the future, or the index. Because of leverage, an investment of $2,500 in options versus $2,500 in the underlying asset may result in greater profits. However, with leverage, the opportunities for greater profits come with the risk of greater losses, and faster ones as well. Options are a very time-sensitive investment instrument. Only an option contract is active only for a set period of time, generally a few weeks or months. The buyer of an option could lose your entire investment even with a correct market direction prediction. So you'll you do have risk. I do not want to give the impression at all that we are not going to have risk with our long option positions, but you do know that the risk is limited to your initial investment. So the options markets provide a mechanism for traders to achieve specific investment goals by tailoring their option strategies to meet a specific set of trading criteria and preferences. An options trader may be looking for long or short-term profits. He or she may be looking to hedge an existing position. Whatever your objectives may be, you need a thorough understanding of options and the options markets where you will be trading. An option is a financial instrument called a derivative. It's called a derivative because the option contract derives its price and value from the underlying asset on which it is based. An option's value will usually change as the price of the underlying asset falls or rises. Now, an option's value may also be affected by other market conditions, such as a rise or a fall in volatility, the passage of time, or changes in interest rates and dividends. Now, way back before computers were widely available, option trading was really not feasible for the average individual trader. The formulas that were used to calculate theoretical option prices, implied volatilities, position values, and risk factors were complex, and they required some pretty advanced math skills, and this gave those of us on the trading floor an advantage because we had the tools to calculate and to evaluate those values. Fortunately, everybody has access to computers these days, and everybody has access to software at TradeStation that can quickly calculate those values in real time throughout the trading day, and this puts us on a more even playing field. As a trader, it's critical to understand all the aspects of the instruments that we are trading, and for options trading, that is doubly so. So the Industry Council, the Options Industry Council, along with other stock and options and futures exchanges, offer an extensive array of educational tools and materials that can help you learn about the fundamentals of trading options. So let's answer a few of these questions. What is an option? Well, an option is a contract that gives the buyer, that we often refer to as the holder of the option, the right to buy or sell a specified number of shares or contracts of a particular underlying asset at a fixed price by a specific date. Each options contract is based on an asset, a stock, a cash index, a forex pair, or a futures contract. The seller, who is the writer of a call option contract, is obliged to deliver the underlying asset at the agreed upon price up until the expiration date. So if you're a seller of an option, you're basically hoping that the price, seller of a call option, you're hoping the price of that option stays below the strike price. That way, you get to hold on to your stock if you own it, or you won't have to go buy stock to deliver to that exerciser. An options trader can both buy and sell, enter or exit an option trade anytime during the life of an option. So a call option, as we just pointed out, gives the buyer of the option the right, but not the obligation to purchase a fixed number of contracts or shares of the underlying asset at a fixed price on or before a set expiration date. The buyer pays a premium to a seller for this right. A put option is a contract that gives the buyer of the option the right, but not the obligation, to sell a fixed number of contracts or shares of the underlying asset at a fixed price on or before a set expiration date. The buyer pays the premium to a seller for this right. So the buyer of a put option will be able to sell shares at a specific price, and they benefit when the price of the stock goes down. The seller of the put option is obligated to purchase the shares that if the stock is put to them in our normal terminology, our street parlance, if you will. So the seller of the put option becomes a buyer if the strike price is below, or the price of the stock is below the strike price. That puts that option in the money, right? We'll cover that momentarily. So here, if we write a call option, this is a contract that assigns to the writer of the option the obligation to deliver a fixed number of contracts or shares of the underlying asset at a fixed price on or before a set expiration date. The writer gets paid for this. We call this the premium from the buyer for that risk. If we write a put option, we have a contract that assigns to us, the writer of the option, the obligation to accept a fixed number of contracts or shares of the underlying asset at a fixed price on or before a set expiration date. The writer receives a premium from the buyer for this risk. The contract specs. Well, the underlying asset that I've been referring to is the basis for the options contract. Remember, the option is a derivative. The instrument that it is derived from is the instrument that an options holder secures the right to buy or sell. So if we are talking about XYZ stock, the option, that is our underlying asset. If we are talking about the SPX or the Russell index, that is the underlying asset. The strike price is or the exercise price, if you prefer, is the price at which the underlying asset may be bought by the holder of a call or sold by the holder of a put. The expiration date is the date on which the option expires. Options held to this date and not yet exercised must be settled, and then they cease to exist. So on expiration date, it's drop dead. We're done, right? There are two types of expiration styles. The American style options that can be exercised at any time until their expiration. Most U.S. traded equity options are typically American style, and this means when our option is in the money and we have the opportunity as a holder of the option to purchase stock along with at a price that makes it attractive to us because it has the stock has advanced beyond our strike price plus the price that we paid for the option, we might exercise our long position and take on stock ahead of the expiration. European style options may be exercised only in a defined period at expiration. Some U.S. traded index and currency options are European style. This means that there is no exercise risk for the short seller. For the seller of the options, there is no exercise risk. Those options cannot be exercised prior to expiration. There are two types of settlement as well. Physical delivery options entitle the buyer of a call option to receive actual delivery of the underlying asset upon exercise. This is quite obvious. If we exercise a long call option, we'll be buying stock if we have an equity option, of course. To exercise an index option, we're going to be settled in cash, not physical. Cash settlement options do not permit actual delivery of that underlying asset, there is no real Russell index, right? There is no real SPX or S&P 100. It is simply a cash-settled transaction. So cash settlement options do not permit the actual delivery of that underlying asset. Instead, if you hold that to term, they culminate in a cash credit or a debit for the difference in value from where you bought the option to expiration. So the difference between that settlement price and your strike price is what you would receive in the cash settlement transaction. Contract value is our final piece in this list. The number of underlying shares or contracts that are controlled by an option contract determines the point value, or the multiplier as it is sometimes referred to. Normally, this is 100 shares of stock or one futures contract, but this can vary for a number of reasons, like corporate actions. A company can announce a 2-for-1 stock split or a 1-for-5 reverse split or something of that nature. As options traders, we don't participate in the actual delivery or the acceptance of stock from the company. So our options are adjusted to reflect the new point value. There are also now a number of 10 share options or mini option contracts that are being offered for high-priced stocks and indexes. It's important to note what the contract value is in determining the profit or loss of an option position. Back in February of 2010, the options industry initiated or brought forward an initiative that they called the Options Symbology Initiative. All stock and index options symbology was changed to a more descriptive system starting at that time. All of the stock and the index options supported by TradeStation, including yield-based options and short-dated options, were affected. The futures options were not part of this initiative, so they still have different terminology or symbology. In this case, this specification on the screen, we see the formula at the top, the symbol root and then a space, followed by the expiration date plus the option type code plus the strike price. So for symbol XYZ with a July 17th, 2015 expiration, that call had a $30 strike. As we break that down into the option symbology, and you can see this on the option screen at TradeStation, it's shown, the option symbol will be shown in this way. The symbol will be available to you. So you've seen how instead of describing it as in a descriptive way, the XYZ July 17 calls, or the $30 calls, they are broken down into this formula, and all to make for greater uniformity. Now there's going to be a quiz on the Black-Scholes calculation for a call option following the presentation. Just kidding. This is, however, how options are priced. The premium that you pay for an option is made up of both intrinsic and time value, and it's based on the theoretical risk in dollars that the options writer is willing to take. Therefore, the option premium is a theoretical measurement of risk and is calculated using this mathematical formula called the options pricing model, or the Black-Scholes calculation. This formula takes into account the many factors that we've discussed that make up the components of an options contract. The options value calculated by this pricing value is called the theoretical value of the option. Modern option pricing techniques with roots in stochastic calculus are often considered among the most mathematically complex of all applied areas of finance. And these modern techniques derive from a formal history dating back to 1877, when Charles Castelli wrote a book entitled The Theory of Options in Stocks and Shares. And his book introduced the public to the hedging and the speculative aspects of options. Just when you thought this was only a 50-year-old industry, you realize that it's like a 150-year-old industry or so. The work that Castelli and another author named James Bonus have done led to the work that Fisher Black and Myron Scholes, who in 1973 introduced this landmark options pricing model, which was awarded along with Robert Merton the Nobel Prize for Economics in 1997. Now, they created this in 1973, and that cleared the way for the CBOE to open in 1973, and allowed for the SEC to actually approve the creation of the option product. Today, the Black-Scholes model is still one of the industry standard measurements for calculating stock and index options theoretical value based on these inputs to the formula: asset price, the strike price of the option, volatility, days to expiration, the risk-free interest rate, and dividends for stock options. Now, additional models and variations have been written over the years to help improve upon that initial model or to calculate theoretical values for futures and options and other derivatives. But it's important to note that although there are models that are fractionally more accurate, Black-Scholes is the most computationally efficient of all of the pricing models available. And it is the default pricing model that we have employed here in OptionsStation Pro. You don't have to be a math wizard to understand or use these calculations. We do it for you, and we display the information in an organized and an efficient way. However, if you're going to trade, you should have an understanding of the factors that can affect the price of an option. So we've created a different way of looking at this. And so let's just all consider that we are average options traders. You have no need to completely understand that formula on the previous slide. And most option analysis tools like OptionsStation Pro provide real-time Black-Scholes and other advanced calculations for theoretical values and pricing. Now, the option premium really boils down to two main components: the intrinsic value and the time value. The intrinsic value is the difference between the strike price and the current price for a put, and the difference between the asset price and the strike price for a call. The time value premium, or the time value side or portion, is made up of several risk factors such as volatility, days to expiration, dividends, and interest rates. Let's look at intrinsic value first. A call option has intrinsic value if the strike price is below the current asset price. A put option has intrinsic value if the strike price is above the current asset price. In those two instances, an option's intrinsic value is the difference between the underlying asset price and the strike price of the option. Intrinsic value, therefore, can never be less than zero. On the other side of this, the time value side, right? Most options will trade at a price greater than their intrinsic value, and this is the time value portion of the option's premium. Time value is the amount in dollars that the writer of an option is charging the buyer to assume the price, the time, and the volatility risk of the option. Time, which we calculate as days remaining to expiration, and volatility are the two main components of time value. Interest rates and stock dividends are a much smaller factor in the pricing equations. The more time until expiration, or the higher the volatility, the greater the risk to that option seller. So the greater the time value component of the option's premium. Any option that you buy is considered a depreciating asset. So as the option expiration date gets closer, the value of that option is going to decrease. The more days there are remaining until expiration, the more time value is expressed in the option's premium. When the option expires, the only premium value that the options contract has left is its intrinsic value, right? That is the amount by which the option contract is in the money, if any. Now on this chart, we can take a look at how options are priced from the standpoint of intrinsic value. Again, let's just back up a little bit. We've purchased one XYZ 160 call at $2. That's in option premium. That's every point in option premium is equal to $100. So an option that has a $2 price tag on it costs in actual $200 in cash. So we've purchased one of these calls at $2 for a cost of $200. Let's take a look at this, right? Our strike is 160. If the stock is at 160, we have an at-the-money option. We don't have a real price appreciation, so we're going to have a $200 loss at expiration. Let me start with the stock price at 155 at expiration. There's no intrinsic value. There's no profit. That option's out of the money, that call. On this 165 stock price, if that's where we are at expiration, we've got $5 in option premium at expiration. It gives us a $300 profit at expiration. In other words, our option was in the money. If the stock moves to 170 at expiration, we have $10 in intrinsic value and $800 in option premium, profit, because our option is really in the money. We would call that deep in the money. A 10-point difference. We picked the right stock in the right option. Congratulations. You have a great trade. So this is how another consideration how options are priced. On this chart, we're looking at what I was referring to earlier, how the how did I want to phrase this? So remember that any option that we buy is considered a depreciating asset. Well, in this chart, the option loses its time value a lot faster in the days that are closest to expiration. Most options are going to trade at a price higher than their intrinsic value at the beginning of their cycle, and that's because the time value portion of the option's premium is beefy. Time value is the amount in dollars that the writer of an option is charging you, the buyer, to assume the price and the volatility risk of the option. Time, or days remaining. Excuse me. That's not supposed to happen. So any option that you buy is considered a depreciating asset, as I mentioned. And so the value of the option will decrease as the option expiration date gets closer. When the option expires, the only premium value left is that the option contract is going to have is that intrinsic value, and that's the amount by which the options contract is in the money, if any. In our chart here, the option loses its time value faster in the days closest to expiration. So to make a long story short, this is what happens to us as we approach expiration. All of the time value on expiration begin to erode. We call this actual process premium erosion as time value washes out. Volatility is a way to measure risk by calculating the asset price movement potential as an annualized percentage. It's one of the main components that affect the time value portion of the options premium. Volatility is a risk assessment value normally calculated in annual percentage terms. There are many ways to measure volatility, the goal being to estimate the expected price movement of the underlying asset over a specific time frame. In addition, knowing what the volatility value is can also help us determine the relative risk between various assets. There are two types of volatility in option analysis that measure the risk of unexpected price movement. Statistical volatility, which is sometimes referred to as historical volatility, and this is based on the historical price movement of the underlying asset, and implied volatility. Now, statistical volatility is expressed as an annualized percentage value. Statistical volatility can be based on various time frames. The most common look-back periods for the statistical volatility calculations are 20, 30, and 60 days back. Implied volatility is a volatility value implied by the current option's real-time price. This is the Black-Scholes model in reverse. By plugging in the current option's price, you can back out what the implied volatility is for that option. This kind of volatility, implied volatility, can also give us insight into what the options markets are saying about the potential future price movement of the underlying asset. When options prices rise or fall without a corresponding rise or fall in the asset price, those options price changes are caused by changes in the implied volatility. Higher options prices in these cases imply higher risk or uncertainty in the market. Therefore, implied volatility can be seen as a measurement of risk. Higher volatility means higher risk for the options seller and higher prices that will be for those options. I urge you to review our other webinars, specifically our Getting Started series, to take an OptionStation Pro tour and go through the processes with our staff instructor, Jesus Nava, as he shows you how to place an option trade, and make sure that you have the ability to place an order, place a trade prior to the prior to actually firing up one and launching it into the market. TradeStation OptionStation Pro is a very powerful option data analysis and trading tool that's designed to provide you with the information that you need to make a more informed option trading decision. It allows for comparison analysis, and you can graph almost any option strategy based on changes in underlying price, time to expiration, and volatility. Are there any questions about what we've talked about so far today? Have a great day. Yes, you're welcome. Thank you.